Hi there, my name is Jason Ayers, Director of Business Development at R& Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thanks for taking the time to watch our monthly review and commentary for July 2018. The end of June marks the midway point of the year, and so far it's been quite a ride. Both the Canadian and U.S. markets logged modest returns, well off their respective lows of the year, but nonetheless underwhelming. That said, markets never move in a straight line, and the path to these modest returns, 0.4% for the TSX and 1.67% for the S&P 500, has been bumpy to say the least. The challenge for discretionary portfolio managers to this point in the year has been interpreting and managing the headline risks to protect investor assets while capitalizing on the upswings. Labor market numbers both in Canada and south of the border offered encouraging signs that economic growth should be sustainable. This, along with U.S. tax reforms, should provide a tailwind. However, geopolitical friction and the ongoing trade tantrum continues to foster uncertainty. The true impact of the most recent tariffs won't manifest until the next round of corporate earnings after the third quarter. However, so far, as of the date of this recording, the markets are moving higher. As our CIO Richard Croft suggests, the trick is to manage through the uncertainty to benefit from a positive endgame. The equity growth fund suffered a small loss in the month of June, losing about 0.34%, while its benchmark, the TSX Total Return Index, was positive 1.69%, led by strong returns in the energy and industrial sector. Lead manager Alex Brandolini comments that the equity pool was having a great second quarter up until the end of June, where concerns around trade wars shifted market sentiment, causing the equity pool to register a flat performance over the most recent 3-month period. Despite this most recent drag, the fund remains up 4.19% on the year compared to the TSX total return at 1.95%. Alex cites 4 key factors influencing fund performance: trade wars, the Amazon effect, the flattening yield curve, and momentum interruption. Short-term market events created a perfect storm within the equity pool since fears of a trade war hit 2 of the pool's overweight sectors, technology and industrials. The Amazon effect hit one of the equity fund's healthcare stocks as the online marketplace acquired an online pharmacy and investors expressed concerns around profit margins. Bank stocks were also hit by a flattening yield curve as banks borrowing short and lending long stand to face margin compression if this trend continues. By the end of the quarter, momentum and growth stocks led the market performance to the downside, whereas value and dividend stocks led market performance on the upside in a flight to quality as trade tensions escalated. Notable actions taken in the equity pool included put writing on momentum stocks to take advantage of higher implied volatility. In addition, with an increased expectation for volatility, some cash that had been sitting on the sidelines was deployed into lower beta stocks. Stocks with lower betas are less correlated with the broader markets and tend to maintain some stability during broader market declines. We also took the opportunity to add to current technology holdings on the most recent market pullback. Out-of-the-money covered call rights on some of these names were also implemented. This option strategy increases the yield in the position while maintaining the opportunity for significant upside in some of the top-performing tech companies. Our income fund finished the month of June up 1.07% compared to the real-world index income benchmark at 0.96%. Year-to-date, the fund sits positive at 2.61% compared to its benchmark at 1.04%. In line with the firm's expectations that the U.S. dollar was due for a pullback, lead manager Mark McAdam reduced the U.S. dollar position and looked towards the options market to maintain exposure to U.S. equities in an effort to mitigate some of the currency risk. As with the equity growth fund, our income fund continues to benefit from market hypersensitivity and the volatility that comes with it. Approximately 8% of the fund's cash has been earmarked for deployment during the upcoming earnings season. We will be patiently waiting to buy solid companies that experience a sell-off due to a market overreaction to short-term challenges, citing Oracle and Alibaba Group as examples. The equity will be purchased with a covered call strategy overlay to benefit from the depressed stock price and expensive option market. Mark also notes that our TLT strategy continues to generate a good return with modest risk. This strategy involves a combination of put writing and covered call writing around the iShares 20-year Treasury bond ETF. Option strike prices and expiration dates are selected based on our expectation on how U.S. interest rate decisions are impacting the bond market. Our option writing fund is designed to drive cash flow using income-generating option strategies regardless of market direction. The fund finished June positive with a 0.54% gain, lagging the Montreal Exchange Covered Call Writers Index, which finished the month with a positive 1.77%. Year to date, the option writing fund and its benchmark are neck and neck, coming in at a 1.63% gain and a 1.62% gain, respectively. Lead manager Richard Croft confirms that during the first quarter of 2018, we moved away from selling short-term options with an average term to expiry of 21 days to selling longer-term options with an average expiration term of 55 days to take advantage of higher implied volatility. While this created a bit of drag on performance in the first quarter, the strategy is paying off as the share class has rallied 4.34% through the second quarter of 2018. Richard further adds that the pool continues to follow a dual-style mandate, with about 50% of the portfolio holding value stocks and another 45% falling into the momentum camp. Most of the momentum plays are with the FANG stocks, for example Facebook, Apple, Amazon, Netflix, and Google, which have rallied sharply despite trade frictions. We continue to maintain this strategy, although we've lightened our exposure to longer-term options as volatility contracts. Currently, our average term to expiry is 41 days. We suspect that this expiry spectrum will continue to contract unless volatility spikes because of a surprise in second quarter earnings or on the trade front. Given the short-term nature of recent news headlines and the fact that they came in a quick and consecutive order, our long-term outlook has not changed as we believe the headwinds to the market will be resolved. Our focus remains on Trump's objectives, analyst expectations on technology, industrial sector technicals being oversold, Fed over-tightening being unlikely, and continued bouts of volatility with our expectations for growth remaining intact. While Trump's tactics appear concerning to the markets, it's useful to evaluate what he wants. We don't think he's interested in the tariff revenue because it is immaterial to running the U.S. economy. Rather, we think Trump is seeking to end intellectual property rights violations taking place in China, and he wants less barriers to entry into Chinese markets for foreign investments. U.S. ambassadors have already come out and said that they could abandon tariffs with European partners in exchange for trade concessions. It's not much of a leap to think that Trump is giving China the same message. Trade policy concerns are also not enough to overcome improving analyst optimism towards second quarter earnings results. Expectations for S&P 500 EPS and sales in the quarter have risen 0.6% and 0.9% respectively since the end of March. Second quarter EPS results are expected to rise 22% from a year earlier. Technology stocks are expected to post 25% year-over-year performance. Technical indicators suggest the industrial sector is overdue for a bounce as earnings season approaches. It is the S&P 500's worst performer since trade concerns broke out. The sector is now testing support at its early May low. The 14-day relative strength index also indicates industrials are more oversold than at any point since the sector's February low. With respect to the momentum trade, growth dynamics haven't reverted, and we believe the underlying market and economic fundamentals support the idea that this has been a momentum interruption rather than a material shift. While the Fed has a mandate to control inflation, it is unlikely short-term interest rates will be increased at a rate that will derail growth. But as always, we will continue to evaluate the markets and adjust as conditions change.